Hey, what's going on? So this is going to be the next video in the fund incubation series. This is going to be price engine Praxis. This is how we actually use the price engine here. We're going to be also doing a live case study. So there are multiple steps here, right? First, we look at the price engine. We then interpret the price engine. We then allocate accordingly. In between the, actual looking at the price engine and the allocating of the capital, there are multiple steps. Um, but really saying that to say the price engine itself does not produce a trade. This is ultimately the compass of the market, right? In between the interpretation of the trade and the actual investing, we essentially get a lay of the land in terms of time horizon, capital mandate, anticipation, and risk parameters. Ultimately, there is no universal action attached to a price engine state. Just because the market is consolidating, that doesn't mean that we do a specific thing, right? One strategy, a long term accumulation strategy, might call for accumulation in a consolidation, right? Another strategy, swing trading, might call for you know, trading within the range of the consolidation. Yet another strategy might call for sitting on the sidelines with consolidation, right? So, three different strategies approaching the same price action in three different ways, right? There is no universal action attached to a price engine state. The price engine simply shows where you are. So we'll go more in depth with these variables here. The first one is time horizon, and it's simply bringing attention to the fact that the price engine is fractal. Every price engine ultimately contains another price engine on the lower time frame and is ultimately within another price engine on the higher time frame. These price engines are existing simultaneously. To prevent information overload, the actual capital operation establishes the relevancy. The quote unquote mandate, which we'll talk about in a second, ultimately establishes which time horizons are the most relevant. This ultimately leads to one price engine becoming the quote unquote governing price engine. This is the most relevant price engine. These engines can align or conflict, right? So, really, the question at all times is which price engine is governing this capital and what are the subordinate engines doing inside of it? And is information ultimately leaning towards or against our thesis of what the price engine is going to do, right? Next is capital mandate. This is the ultimately objective assigned to this specific pool of capital. This capital role is known before entering the market. Most people essentially do the opposite. Most people enter into the market and then decide what this pool of capital is doing, right? And so that is obviously not what we are doing. Some examples of this could be a trade becoming a long term investment because it went against you. It could be an accumulation position being sold because of lower time frame volatility. It could be reserve capital being deployed impulsively. The problem here is not correct, or excuse me, the problem here is not incorrect market interpretation. The capital itself is ambiguous. So ultimately, the praxis here is requiring answers to the following questions. What pool of capital is being exposed here? What's its objective? What price engine is governing it? What conditions are justifying this? And ultimately, what conditions would negate this position? One asset can ultimately contain multiple capital mandates simultaneously. So, for example, you could be accumulating Bitcoin long term while simultaneously positioning that long term position around different transitions, right? Potentially taking profits every 1 to 2 years or something like that, every 6 months, a quote unquote position trading type of thing going on with, point two here. And then finally, we have the trading of Bitcoin potentially with, weekly ranges and lower time frame in general, right? Saying that, say, like you can be on the long term, the short term, and in between in the same asset class, right? That ultimately tells us that when you say I'm long Bitcoin, this is not, saying that you're long Bitcoin is not the same as running these three different strategies simultaneously with the same asset, right? And so the real question is, what is the strategy here? What is the mandate around Bitcoin? Or, multiple mandates, etc. And yeah, the mandate ultimately determines what constitutes opportunity. The same price engine state does not offer every opportunity to every pool of capital. In a way, this is kind of a good thing, right? This allows you to ultimately put blinders on with the market. We already talked about this, right? But consolidation might be an opportunity for one person and quote unquote unideal conditions for another. The price engine itself is the same. There are simply two different capital missions there. These capital mandates prevent cross contamination. And this is ultimately when info relevant to one capital operation improperly influences another. So here's some examples. A 5 minute reversal causing a large exit of a long term position. A long term bullish conviction causing forcing of an invalidated day trade. Another example is profits from active trading are immediately redeployed into speculative positions despite being designated for reserves. These aren't necessarily like like that in and of itself isn't necessarily something that's part of the fund, but this is a hypothetical example. It's also not necessarily not part of the fund. So either way, right? Another example is a short-term drawdown changes your interpretation of a structurally unrelated long-term position, right? Literally experiencing drawdown itself causes you to change your thesis on this other, like this totally unrelated pool of capital, right? That would be mandate contamination. Having a thesis of deploying, any profits from active trading immediately into reserves, instead experiencing or seeing something, right? Seeing some hot stock tip or some news article that then causes those reserves to then be prematurely deployed into a speculative position that really didn't exist 5 minutes ago, right? So all of this is to say that capital separation ultimately leads to analytical separation. This mental compartmentalization is extremely advantageous. These mandates can evolve, but they should never quote unquote drift, right? These mandates are not permanent. Capital can be reassigned. Things change in the markets, right? Profits can become reserves, etc. However, any and all evolutions of the mandate or the fund itself are done through a deliberate process. This deliberate process is completely different and diametrically opposed to unplanned change caused by price and or emotion, right? So we've talked capital mandate, we've talked time horizon, now we will talk anticipation here. Anticipation describes the path the operator believes the price will take. Examples here: currently we're in consolidation, we're anticipating expansion. We've seen expansion and we saw a retracement falling. Now we are anticipating more expansion. We saw expansion. Now we are anticipating reversal. We've seen expansion. And now we've seen retracement. We're in retracement. We are anticipating reversal, right? It's much more in depth than we think, than quote unquote, we think price is going higher. It is, we believe price is currently in this state. We are organizing a capital operation, a trade or an investment or a series of trades and investments around the possibility of this next state occurring, right? This anticipation ultimately creates orientation. Without orientation to price, it is very easy to become reactive to the market. This is where every movement in the market ultimately becomes a emotional pulling back and forth, right? The observer no longer becomes the observer, and then they are pulled back and forth by the swing highs and lows of the market. Simply focusing on what is the current state, what is the future state, really again creates a mental focus and allows you to zone out or filter out the things that are irrelevant. Simply, is price developing according to the anticipation? Is this taking longer than expected? Has the anticipation been invalidated? Those are the questions. Not necessarily, oh wow, look how much price just went up and down and up and down. Oh wow, I wonder who caught that. I wonder who made money on that. Yada yada, right? The purpose of anticipation is not to predict perfectly. It is to create a structure that you can essentially measure new information as it comes in against, right? One state can produce multiple possibilities, right? We understand this. Our anticipation could ultimately not pan out, and therefore that is why we use risk management. The capital mandates and risk parameters then determine whether any anticipation justifies a capital operation, right? Anticipation is not certainty, it's organized uncertainty. Anticipation exists before exposure. And anticipation is never invented to justify capital operations, right? We don't come up with some anticipation just because we're bored and we want to trade, right? The capital operation occurs first. The mandate occurs first. Then inside of that, anticipations are formed within advantageous time horizons, right? So first we observe the price engine state. We then interpret what we've seen. We then ultimately find what is the most relevant price action here, what is the most relevant time horizon, and ultimately what is the most relevant price engine. We then develop a capital mandate or already have one developed. Only then we anticipate, and then finally we actually invest or trade. So the danger is in reversing this sequence, right? Most people actually just get in and then they come up with a risk plan and then they figure out what's the most relevant. And then finally they look at what price is actually doing, right? The danger in reversing this sequence is that you ultimately end up, quote unquote, defending the market and defending your position as opposed to objectively looking at the market. Anticipation is path dependent. So, for example, we could be expecting higher prices. We understand that this could occur through a like multitude of different price engine patterns or price engine scripts, the price engine script is actually the anticipation, right? Price could consolidate, then expand, or it could consolidate, expand, and reverse higher, right? Or it could consolidate, expand, retrace, and expand, continue higher. All three could eventually produce higher prices, but create different environments for capital exposure. Destination is not anticipation, script is anticipation, right? Consolidation to expansion is an example of an anticipation. Consolidation, expansion, reversal is an example of an anticipation, not simply price is going to go higher. We're not simply forecasting the price is going higher, we're saying how price is going to go higher. We've already talked about this, right? But ultimately, in the higher time frame, we could be anticipating consolidation to expansion. On the lower time frame, we could be seeing expansion, retracement, expansion, right? All of this can coexist and even be against each other directionally, even though this specific example was not, right? This was directionally correlated, if you will. These anticipations can coexist and not be contradictory simply because they exist at different scales or different time frames within the price engine. The capital operation understands what anticipation it is organized around. This prevents lower order price engines from rewriting the operation. Anticipation requires failure conditions. An anticipation that cannot be challenged is just a belief. So ultimately, we understand what price engine supports the anticipation, what weakens it, and what invalidates it. This does not necessarily prescribe a capital action. Invalidating an anticipation and exiting a position are not necessarily identical events, right? For example, we could just be having an anticipation, just simply looking at the market. You know what I mean? No position is even there in the first place, and there's not even an intention to build in a position, right? But at the same time, too, we could have anticipations within our higher time frame accumulation portfolio. If those are negated, we're not going to immediately turn around and liquidate the portfolio, right? However, those anticipations could be relevant to swing trading or other strategies, right? This is ultimately, saying that say capital mandates and risk parameters matter. So now we'll talk risk parameters. Ultimately, what is risk? Risk is the boundary placed around a capital operation. Risk parameters define how much uncertainty an operation can absorb before the operator must reconsider, reduce, terminate, or reclassify. Risk is not simply where does the stop loss go? Risk exists across several dimensions. So here's some interesting examples here to think about. First is capital risk. How much capital can be lost or impaired? The next is price risk. How far can price move adversely before the operation changes? The next one is time risk. How long can the anticipated transition fail to develop? Then we have thesis risk. What price engine development would weaken or invalidate the anticipation? Next is exposure risk. How much capital can be committed at each stage of the operation? So without these parameters, the mandate and anticipation ultimately becomes belief, right? More specifically, open-ended belief. Risk parameters are mandate dependent. There is no universal definition of an adverse movement. For example, a 20% decline could wreck someone and another person is fine, right? Risk cannot be defined independently of the mandate governing the capital. Risk cannot be defined independently of the governing price engine. Risk is the cost of maintaining an anticipation. Once a capital operation is executed around an anticipation, uncertainty is accepted while the script develops. Uncertainty has a cost: capital volatility, time, opportunity cost, psychological load, liquidity requirements, possibility of loss. Risk is the amount and type of uncertainty the operator is willing to absorb while maintaining a capital operation around an anticipation. So ultimately, right, this avoids reducing risk to just risk 1% per trade. This is a very common trope, right? Oh, just risk 1% per trade. That might ultimately be true, but there is more to the story there, right? Risk parameters define the operating envelope. The operating envelope is essentially the range of conditions within which the capital operation remains coherent. Inside this envelope, the market can do a variety of things while essentially remaining intact to the thesis, right? However, at the boundary of this envelope, new info requires reassessment. Outside of the envelope, the original operation can no longer be assumed to remain coherent. So this doesn't necessarily mean that every breach automatically means quote unquote sell, right? But that at the same time but that might be exactly what that means, right? Really, what it means is that we've reached a new condition that requires a new decision. A key point here is that risk parameters exist before exposure. Both the anticipation and risk in envelope exist before exposure. Otherwise, emotion takes hold. Capital enters the market knowing its mandate, anticipation, and operating envelope. To reform, refine, and update these anticipations, we use an entirely separate analytical language to interpret location, evidence, and structure of price. This is essentially later down the line. Now we will talk about a case study here. So this is ultimately how I've invested in Bitcoin from an accumulation perspective, a long-term accumulation perspective this year during 2026. Bringing it into the market efficiency paradigm briefly here, right? We understand retail. We understand the behaviors, patterns of retail and characteristics. We then understand smart money, the skills necessary, the behaviors, traits, and characteristics necessary. So here is Bitcoin price action. This is off of the daily chart. This is what we've seen so far this year of 2026. Here's the 2026 open here, right? Simultaneously, that open level, that price open there. So either way, right, we see December 2025 here. We had a consolidation. 2026 opens, we then expand. From a more in-depth perspective, this expansion was made up of what? Expansion, retracement, expansion, right? To and through the December high, to and through that consolidation. So we've gone from consolidation to expansion. After this expansion, we ultimately reverse lower, right? Looking more in depth at this reversal leg. After this expansion, we ultimately retrace, right, up to this point, as of January, mid to late January. It looks like we've kind of just retraced back into the consolidation. Right? Kind of another consolidation here, but ultimately within this reversal leg, right? And so what does price look like as we're retracing? Potentially there is a consolidation, expansion, retracement as we're making these candles, potential continued expansion, right? This breaks down, we ultimately continue our retracement here, right? This is just deeper retracement and back into the consolidation. We then potentially expand again, right? Before finally continuing to reverse, right? All of that within the consolidation, expansion, reversal, right? After this reversal, right, we are now in February. February open, I believe, was here. February ultimately continues the expansion lower, aka the reversal lower. We then consolidate. March continues to consolidate. Right, we do continue, we do trade higher, but ultimately continue back towards, come back into the consolidation. April opens here. We then expand higher. May opens. We continue that expansion, put in the high here. We then retrace during May, right? Same situation that we were touching on over here. As price retraces, we see a potential expansion going on here, right? Potentially price is turning around until it's not, right? So we see expansion, retracement, expansion. In fact, it is expansion reversal, right? So again, consolidation, expansion, reversal. We are now currently inside of the consolidation, right? Took this yesterday. This is from yesterday, essentially last night. But either way, we are in a consolidation again. But either way, on the lower time frame here, right, we consolidate, or excuse me, we reverse lower. We then consolidate here going into June. I believe the June Open was one of these days here. Either way, we expand lower, right? As part of that reversal, we then reset, we consolidate. We then expand higher relative to this consolidation. We then retrace, fail to continue higher as another expansion leg. We then reverse to and through the June low here, or the intramonth low, if you will, because this occurred during June. We then reset yet again and consolidate. Then we open July here, expand higher relative to this consolidation. Now we are ultimately, in my opinion, back inside of a consolidation. And all of this ultimately manifests within a consolidation, right? And so really, 2026 has kind of been a consolidation year here for Bitcoin. Um, it is ultimately understanding from, as we talk here, this is an accumulation portfolio. We can't control what Bitcoin is doing. We are simply looking to buy at a discount. We are looking to buy as price goes lower. And so this is what I've done so far this year, right? I've had essentially two accumulation windows. I accumulated in February as price traded lower. I essentially accumulated in this consolidation. And my second accumulation for the window was here in June in this consolidation as well. And I had one accumulation for the first day of July as well. So this is where I'm at so far for long-term accumulation as it relates to Bitcoin from a portfolio management perspective. At the beginning of the year, I was essentially 0% risk on, if you will, as it relates to my accumulations. Currently, I'm around 30% risk on over these, 6 months. Ultimately, I am anticipating lower prices in Bitcoin. I would like to see price trade to and through the July low. I would like to see lower prices before eventually we do see higher prices. So everything we just touched on, right? All of 2026's price action is right here, right? This is now off of the weekly time frame. So each one of these candlesticks is a week. Each one of these candlesticks here off of the daily time frame was a day. So again, you can see the price action, how we have ultimately traded lower during 2026 here. This is 2026, right? Saying that to say all of this has occurred, this trading lower has ultimately occurred within a higher time frame range, right? So what did we do from 2023 to ultimately mid 2025? We expanded higher. What are we doing right now? We are retracing. And so all of this is occurring within a higher time frame retracement, right? That is the foundational thesis here, is that we are essentially accumulating during a retracement opportunity, anticipating higher time frame expansion eventually. This whole entire year of 2026, similar to 2022, could be a retracement year before then expanding higher, right? So either way, from a more formal perspective, I kind of already just like went through all of this in that little, touching on what I just touched on here. But either way, the mandate is that we want Bitcoin exposure long term. The higher time frame interpretation is that the expansion high has led to a retracement lower. We literally just said that, right? This retracement will eventually lead to another expansion higher. So here's the actual praxis and application as it relates to this asset Bitcoin within the crypto asset class. The mandate is to build long term Bitcoin exposure. The governing interpretation is that there is a higher time frame retracement currently occurring. The anticipation is that lower prices and repeated subordinate price engine sequences will occur inside the retracement before eventual higher prices. So the accumulation logic is essentially when price expands lower and then resets as consolidation, expose accumulation capital. So that is what we have done, right? As price expands lower and then resets, ultimately this expansion lower manifested as reversal, right? And then resets as consolidation, we accumulate, right? That expansion lower as reversal, right? And then we accumulate. This could also be seen as consolidation, expansion, reversal. And then as we go back to consolidation, then we accumulate. This was kind of just, a simpler way of saying that. So either way, the risk posture is that partial exposure is maintained, right? About 30% risk on. That's partial exposure. My deployment capacity is retained significantly for future lower prices. And ultimately, that is personally, ideally, that is around fall. There is sort of a narrative out there that Bitcoin is going to put in the low in October, right? That's what everybody thinks. I wouldn't be surprised if we don't do that. And if it actually happens before or after, 2022 showed us that Bitcoin can continue lower throughout the entire year. And so I would be, looking for that as well. That's sort of a different conversation. That is a narrative conversation. But I thought I would, I guess I'll just throw that in here, right? That is my thesis, though, for ultimately only being 30% risk on. Yeah, that's all I'll say about it. When Bitcoin expands lower within a higher time frame retracement, simply expose accumulation capital. The price engine is used as an accumulation protocol here. So to expose an accumulation portfolio to Bitcoin during a larger retracement, wait for an expansion lower, then accumulate during the consolidation that follows. That is the basic idea here. It is from the market efficiency paradigm perspective. We understand that when Bitcoin goes lower, retail experiences fear. They are more likely to sell. Therefore, we want to buy. There is more to the story there, but that is the basic understanding. So, yeah, thanks for watching.